guest says that the path to the Fed's 2% target is quite optimistic. He doesn't expect the Fed to begin cutting rates until at least around mid-year, possibly even later in the year. I want to bring in Stock Traders Almanac Editor-in-Chief Jeff Hirsch. Jeff, let's talk about that for a moment. So, listen, it's, the street started off with 6 or 7. We're down to maybe 3 or 4. But you still think that's a little optimistic here?
I think 2 or 3. I mean, if you look at the PC number, we get that out this week. The month-over-month change, we did a projection. We first did it on the CPI, and then with last month's CPI number that you guys were talking about a little while ago. We did that for the PCE, and we took the chain index, the one that the Fed actually uses. If you go to the Fed database, the St. Louis Fed, down to the footnotes of the PCE, chain index, not the one that excludes, anything. It says this is the one the Fed uses. So we took that, and any month-over-month change greater than 0.1% is going to make that 2% target much harder to attain, and that's exactly why I think we're not going to get a cut until after mid-year, and after the Fed gets to see its quarterly results in June. In
the meantime, you're telling investors beware of the Ides of March. Next week is March. And of course, we've got all of these different patterns, folks. The one that we really should be looking at, though, is the green one, because we've got a sitting president, and the purple one, which is where we are now. So you're saying maybe we move down to historical patterns here, maybe a little bumpiness into March, but then it should be back off to the races.
I mean, if the seasonal patterns, which have been tracking so closely the last several years, I mean, last year was a textbook pre-election year, textbook seasonal, fourth quarter rally, et cetera. And, if we look at that historical pattern of a sitting president running, sets up with the Ides of March seasonality. And also there's some weakness after triple witching in March and the end of Q1. So there tends to be a couple sellers. So you look at some of the seasonal work there. The bounce back after 09 and 2020 changes the averages a little bit, like Liz was saying. But there's still tendencies for weakness in March.
So let's say we get the weakness. Where should we be looking at key support here on the S&P?
I would pull this chart out a little bit longer, because the 4,800 level, the old all-time highs, is where I see a big number. And I like to draw that line as thick as you can.
As far as this day, okay. But, right around here, right around a little bit of 50-day, right? 50 days right now.
Exactly. And then below that, you can see is this the old summer highs, right? The 4,500 level, which is near the 200-day.
So it was here. It formed a double top at one point here, but
there's that breakout gap in October. That's kind of just a little technical.
So 4,800 is okay. It's reasonable. Maybe people looking to buy the dip. If you are looking to buy the dip, some of the names that you like here: Reliance, United Health. Let's talk about just what do they all have in common? They're not the Magnificent Seven.
No, they're not sexy. Last time I gave you a couple of we talked about Supermicro. But these are stocks that come through our screens. We do them at the beginning of the best 6 months. They got, acceleration of revenue growth and earnings growth, good valuations, flying below Wall Street's radar, decent strength.
AIZ, what is that?
Insurance juggernaut, electronics, products.
MCOR?
They're doing construction for data centers, semiconductor facilities, biotech.
Big beneficiary of the inflation.
Both these are at new highs today. These are November 2023 picks. These are old picks from 22 that are starting to move. United Health still flat, but everyone's going to be using healthcare, and this is the only one that looks good right around these prices. The other ones I like at a dip, in that seasonal dip we're talking about. Reliance, metals, steel.
So, I mean, these all sort of benefit from the money that is coming in. It's already scheduled. It's already in the pipeline. We know this money is going to be gushing into the economy, and that they should be major beneficiaries.
Most definitely.
Jeffrey, thank you very much.